This episode of the podcast is generously hosted by Progressive Equity Research. Visit their website at progressive-research.com. Hello and welcome to episode 31 of the Desert Island Investor. Mark, welcome back to the island. You've been out of the country for some time, but almost as soon as you have returned, you've been down to London for your annual pilgrimage to the Fundsmith ASM.
Nice to be back with you, Paul, and thank you for the kind reception that you and the parrots laid on. In recognition of how you've taken care of the island while I've been away, firstly, I'd like to present you with these couple of mementos. Don't say I never give you anything, Paul.
Okay, thank you very much. Yes, the package had arrived, and yes, I confess I have already opened it, and thank you very much indeed. It is a lovely Fundsmith branded notepad and a nice shiny pen, which I shall use for, I don't know, shopping lists or something, I suspect. But yes, thank you very much for that. Now, we've covered Fundsmith in the two previous years, and it is an integral part of your portfolio. So can you share where it stands in relation to your other investments?
Well, there's three legs to my broader portfolio. Fundsmith accounts for 41.9%. The portfolio that I manage or mismanage, and which we talk about mostly, is 37.5%. And lastly, my pension that's in trackers is at 20.6%.
Okay, now we've covered the Fundsmith history and strategy previously, and they release a recording of the ASM for people to consume directly themselves. Now, this year, I'd like you to share some of the key aspects that you took away from that meeting. This is a major commitment, both in terms of cost and time for you. So is there any true benefit in actually attending the ASM in person? And I believe, obviously, you're a great admirer in Terry Smith. And I would like to share any similarities or indeed any clear differences between how you run your portfolio and the Fundsmith strategy. And lastly, we generally use this as an opportunity for you to compare your performance over the previous year. You had a particularly good 2024, so I'm allowing you to wallow in this and explain what exactly went right.
Well, I'll thank you to take that surprise tone out of your voice, Paul. I'm very loath to compare myself directly to Terry Smith, and I don't want to do what you could call like a Dan Quayle, who was a Republican senator who in a debate back in the 80s compared himself to John F. Kennedy. And he was up against Senator Lloyd Bentsen, who came back with a riposte. I'll try an American accent here. Senator, I served with Jack Kennedy. I knew Jack Kennedy. Jack Kennedy was a friend of mine. Senator, you're no Jack Kennedy. So we keep hammering this home again and again. We're not trying to pass myself off as an investment professional, guru, sage, tipster, or forensic accountant. I'm simply a private investor. There's a lot of these in the world. I just happen to be an experienced one for 40 years. And don't worry, I'm not expecting people to be straining to touch the hem of my garments, Paul.
Right. Okay. Very little chance of that happening, to be honest with you, Mark. But let's kick off with the main thing that people are interested in, which is performance. Fundsmith recorded an 8.9% return in 2024 versus their benchmark, which is the MSCI World Index, which was up 20.8%. I can see you smiling now. So how did you do last year?
Well, I was actually 25.5% to the good. Now, when I went away, I forgot to take my year-end figures for 2023. So I only actually learned how I'd fared in mid-February upon my return. So your mind plays tricks with you, and I was pleasantly surprised with the result. In terms of benchmark, well, what do you pick? Which index? I use Fundsmith as my benchmark.
Fundsmith declare their top 5 winners and losers, and what were they?
Meta Platforms, these are the winners, which used to be their Facebook, up 4.5%. Microsoft, 1.9%. Philip Morris, 1.7%. Stryker, who were into medical technology, 1.6%. and automatic data processing 1.5%. Now, these percentage figures are given as the extent to which they attributed to the fund's performance. On the downside, L'Oreal was down 2%, IDEX 1.2%, they're pet healthcare. Nike 0.7%, Brown Forman 0.6%. People probably know that better as the producers of Jack Daniels. And Novo Nordisk, who are into insulin and weight loss drugs, their downward attribution was 0.6%.
And what about Mark's portfolio?
I'm not tempted to pitch this like Jordan Belfort from The Wolf of Wall Street when he says, one thing I can promise you that I never ask my clients to judge me against my winners. I ask them to judge me on my losers because there are so few. But of that 25.5%, it's a total return. So that includes dividends, which probably are about 4 or 5% with the odd special thrown in. Now, I've not gone back and calculated it, partly as it's a little onerous as I switch brokers during the year. But in 2024, I put in no new money and I withdrew no money, so it's an easy assessment. I did make withdrawals from Fundsmith, and this was not to invest elsewhere, but to support my lifestyle. And I'll just digress a moment on that if I can. I did encounter a glitch when I was out in Mauritius. And in order to access my Fundsmith account, there's a triple lock: email address, password, and then you also receive a text. Now, this isn't something unique. I carry very little cash as I remain fully invested. And instead of topping up my cash levels ahead of going, I thought I'd do it when I arrived in Mauritius. Now, unfortunately, there's a 60-second time limit on entering the code. And on several attempts, it was taking the text several minutes to arrive. So I was timed out. Now, I'm not sure it's got more satellites to bounce off. So this therefore had the potential to be problematic. However, that was on Elaine's account, which suited us, especially for me to withdraw from that. But on using mine, there was no problem. So presumably it's because I use a different phone network. And it's just something to consider. I suppose with any form of account, it's the accessibility. Luckily, we had an option, and I don't think I'll run things quite as close next time. But getting back onto the portfolio, an advantage of my portfolio is that some of the AIM stocks have certain IHT benefits. And also by simply selling units in Fundsmith, unless I was simply taking the dividend income, it may involve liquidating a holding, and I'd have to make a decision of which one to pick. And in my case, what happened for me, the winners were the bigger holdings and those with more conviction. And that's always the best case. Your smaller holdings don't move the dial as much. And I've selected my top 8 holdings at the end of the year to back this up. Now, due to the growth, they may not have started the year in that position. They bounce around all the time. But I'm just using this as a broad exercise. My largest holding, Me Group, was up 64.5%. MPAC up 117.3%. Smurfit West Rock, which was previously Smurfit Kappa, up 38.4%. MP Evans was up 32.5%. Greggs up 6.4%. Tesco 27%. Concurrent Technologies 68.7%, and Unilever plus 19.4%. Now that, again, I'm just reiterating that was at the year end, and these prices are moving around, and in particular in the last couple of days, Greggs has gone down quite a bit. So that is just at that actually moment in time. Now, there were some others down the league table that added, but obviously not to the same degree. Now, Ampario was up 74.6%, and MTI Wireless was up 23.2%. But then I've got one that I'm actually embarrassed to hold that I'll share with you and the audience, Paul, and that's Barclays at 74.6%. Now, there's no way I should be holding Barclays. It's what I call a legacy stock, one that I've held for many years when my strategy was somewhat different. I can't envisage I'll ever add to it. I have this and perhaps one other that really I should dispose of, but never got round to it. Now, what do I know about international banking? The accounts are opaque. banks are subject to fines and government intervention. I used to be with Barclays stockbrokers, and I did think it would help me monitor the performance better in case anything was amiss, and hoped I would receive preferential treatment as a shareholder, which I did not. During the financial crisis of 2008, they were one of the few banks that didn't require a bailout, and they actually bought Lehman Brothers out of bankruptcy. And I thought it was well placed, but it didn't transpire. And it's been a perennial underperformer. However, in 2024, it had a year in the sun. It will go at some stage. There again, that's the basis of the strategy, doing and interfering as little as possible. I suppose this is one of the benefits of being a private investor. We can do irrational acts. We're beholden to nobody, and we don't have to revert back to shareholders at the end of the year admitting we're investing in something that we have no real command of.
Expanding on that point, what advantages do you have over a fund like Fundsmith?
Well, my size can be an advantage. Both Fundsmith and I can buy into those really large caps, but they cannot touch the micro businesses that I focus on. In that respect, I've far greater reach. Due to the liquidity, they have a limited universe. There are some really good companies that are simply too small. Also, there's portfolio management. Me Group, my largest holding, accounted for 13.2% of the portfolio at the year end. Now, I can allow that to run and run if it performs well. Funds are subject to rules on exposure and are forced to trim their winners. In my time, I've had several conviction positions where I've what you could call gone big, and often a fund just can't fill its boots.
Continuing on the subject of portfolio management, then, how many holdings do you have versus Fundsmith?
It's not dissimilar, Paul. Fundsmith have got 28, whereas I currently have 31. Of those, Alliance Pharma have accepted a bid, and Zytronic, a very bad investment for me, which is being liquidated with the proceeds expected to be as little as between 46 and 60 pence. So I'll lose two of those holdings over the course of the year. A couple of comments. Terry has Julian Robbins as his wingman and a team of analysts to share the load, whereas with my portfolio, it's just me. So there's no way I can do the same deep research as them. Time is a factor. And as an example, I was travelling down to London last week, and Tristel, another holding, released their interim results. I quickly scanned them and saw that there was an investor meet company presentation at 11:30, which I would miss. Now, if I'd read further, I would have noticed that there was an in-person presentation in the city at 4:30 p.m., which I could have attended that day. Now, was it mission critical? Perhaps not, but it would have dovetailed nicely as an opportunity to meet the new CEO. It just shows that things do slip through the net, and the more you read and research, the better. The wider the portfolio, the thinner your command. Another aspect is the shape of the portfolio. I would suspect that the distribution of funds within Fundsmith from top to bottom across the portfolio is a lot smoother than mine. As of today, of those 31 holdings, the top five account for 46.8% of the portfolio, the top 10, 73.4%, and the top 15, 86.8%. So you can see how insignificant the remaining 16 are, accounting for just 13.2% between them. They're in what you could call the academy, or it's my advanced watch list. In many ways, I have a smaller portfolio than what might first appear.
One stock that you mentioned earlier, Unilever, is held by Fundsmith and also by yourself. We covered this business and we spoke about the new CEO, Hein Schumacher. Quite timely, on the morning of the Fundsmith ASM, Unilever released an RNS advising that he was leaving the company. So was this discussed at the meeting?
Well, firstly, it's the only business where Fundsmith and myself overlap. And as of today, Unilever is my seventh largest holding. I think it's Fundsmith's only UK holding, and on their most recent fact sheet, they've got 3.4% of the fund invested in the UK. Now, I'm presuming this is all Unilever. So if this was transferred into my portfolio and added to my holding, Unilever would then be my second largest holding. So it's an important business to me. And this is one of the big things I wanted to take from the meeting. So during the winter, I met up with Daniel Washburn. Just a bit of an aside, he's one of the research analysts who lives out in Mauritius. And given the number of funds that the funds holdings that use palm oil, I forwarded him our first episode of the MP Evans pod, and he responded in an email saying how some nice things about it, and hoping we could have a brief chat. So we got together on the night, and Daniel said that only the previous week that they met with Unilever, so we're somewhat surprised by the announcement. But what he then said was echoed by Terry and Julian during the Q&A. They were being very pleased by the progress Unilever have made under Heinz Schumacher, especially in following the direction and what I'll call indulgences of previous CEOs. And I feel that the pendulum has swung back in the direction of shareholders. Now, however, Schumacher is being replaced by Fernando Fernandez. That's an easy name to remember. He was the CFO. He's an Argentinian. And Terry, Julian, and Dan were all singing from the same hymn sheet, with Dan saying he felt very sorry for the CFO that has to come in and replace him. Terry said it was felt that Schumacher had not done a bad job, but that Fernandez will be even better. So Terry used the word dynamite to describe him, and I think Julian used fantastic. They maintained Unilever as their stock for 2025. So not only was I reassured, but enthused, and it would appear that big things will happen at Unilever and at pace.
And I understand that Unilever was singled out as a company with good management incentives.
A slide showed that Fundsmith always vote at AGMs, 100% record. They vote against the director remuneration broadly 50% of the time, so that's not insignificant. And they explain that, and are we surprised, that the bar for hitting incentives is generally set very low. I have been guilty of not voting in the past, particularly with companies with very high caps, say Tesco. So I've been guilty of thinking, what is my vote worth against a fund manager who owns perhaps 10%? But what if everybody thought along those lines? I believe there is a responsibility on shareholders to use our vote, just like in general and local elections. And we need to do our bit to keep those errant directors on the straight and narrow. And I think I need to do more.
Now, Fundsmith try and do nothing. And one of the basics of the desert island investor is to tinker with the portfolio as little as possible. So what were your respective churns?
Fundsmith had 3 outright sales: Diageo, the drinks company; McCormick, probably best known to you, Paul, for Schwartz Herbs, a king's ransom in a jar; and Apple, where they seemed unconvinced and deliberated and dithered in the first place before buying into it. There were 2 additions: Atlas Copco, who are a Swedish tool manufacturer, and Texas Instruments, a manufacturer of microprocessors. So Fundsmith spent just 0.002% of the fund's average value on voluntary dealing. And I think that was something in the region of £400,000 against a fund valued at 22.7 billion. So that's miserly. For my part, I made a total of 13 trades in 2024. Now, I'll not give that as a percentage of my portfolio, as the astute will be able to easily reverse calculate the value of my portfolio. But again, it's extremely low. And there's not many things I can control, but I can control how much I trade. I made 2 outright disposals, and there was the one addition, Nichols, who produced Vimto. So you could say I out-nothinged Fundsmith.
Now, Diageo was an interesting departure, as the fund has owned it since day one.
They expanded on this, Paul. Drinking habits are changing. In my local, the Park Inn, and I'm sure it's the same in the 6 locals that you go into, Paul, it's an older person's pastime. And this phenomenon is in plain sight. Young people don't drink anything like you can, Paul. And at Christmas, I was tempted to buy a bottle of Jack Daniels or Beefeater Gin because the bottles are square and they don't roll away when you you fall asleep on a park bench. So,
Very funny, very funny.
yeah, okay. But after being such a consistent, predictable sector for decades, backed up with heavy marketing, it looks like perhaps the best days are behind them. Um, the legal availability of marijuana in the States was cited as a reason, but also the use of weight loss drugs and drugs being used to treat alcoholism. So you can see that one beneficiary to the fund, Novo Nordisk, is damaging Diageo and eating its lunch. So there's a winner and a loser through this. Now, Fundsmith have nevertheless retained a foot in the alcohol camp with Brown Forman, who I mentioned earlier, Jack Daniels. And there remains a train of thought that as the volume of alcohol reduces, there could be an increase in the premium brands through affordability. People will be drinking less, but higher quality.
You mentioned earlier that your pension is invested passively in trackers, and I believe this was discussed as a reason for distorting the market.
This is apt, as it's something I've been watching and wondering for a while. The weight of money that is moving into trackers. Now, they offer very good value and often beat fund managers as you're not paying their fees, especially closet trackers who are active fund managers but just hug the index. Now, one thing about a tracker, it has no brain. All it does is simply buy what's in the index, regardless of the fundamentals of the business or the valuation. The more money that's thrown at it, the more that position in the index is secured. So it's no surprise that many companies have run away in terms of valuation. And there's room for trackers, but to work you also need enough actives. So I don't really know where the sweet spot is.
You say a year is a short period of time to make an investment assessment, notwithstanding Fundsmith's performance since inception. In recent years, it has lagged the MSCI benchmark, and I'm sure the tracker situation with stocks like Nvidia has skewed the index. So in 2021, Fundsmith was plus 22.1% versus plus 22.9%. In 2022, down 13.8% versus 7.8%. In 2023, plus 12.4% versus plus 16.8%. And in 2024, plus 8.9% versus 20.8%. Therefore, it has underperformed for 4 years now. Now, that's a significant amount of time. Are you still prepared to be patient? And what was the mood in the room?
Investors are remarkably fickle and they expect often guarantees. And it's a little like Manchester United supporters who only know success and they expect a win every week. However, I was surprised how upbeat people were, as I remain. Sky News' Ian King's selects the questions, and Terry and Julian are prime. So there's no sense of tone in the questions or the chance to have follow-ups like you sometimes have at a normal annual general meeting. The venue, Westminster Central Hall, opens its doors at 5:45 p.m. for a 6:30 start. So there's limited time to network. And then after the meeting, you're ushered out onto the street pretty quickly. But I'm speaking to people as a collective. If there's such a thing as a typical Fundsmith investor, they seem to have bought into the strategy. Yes, they've underperformed the index in recent years, but they are still very good companies. And we increasingly appear to be in a very fluid world. And comes something cataclysmic, then the very defensive nature of those businesses will be very comforting.
Now, I've actually seen a photo of you with Terry Smith. Had he much to say to you?
Not really. I was deep in conversation with Dan Washburn when Elaine, who had been in a separate conversation, said, "Have you a minute, Mark?" And I turned around and Elaine had asked if it would be okay to take a photo with Terry. Now, I understand that Terry has done some amateur boxing, but you know how formidable Elaine is, Paul. You know, Terry had little or no say in the matter before he managed to make good his escape.
And in that limited time, any other meaningful conversations?
I was really pleased to see Neil Allardyce, who was private client director at Fundsmith, and he's been very beneficial to me through the financial guidance he's been able to dispense at Fundsmith. Now, while I was out in Mauritius, I have been investigating the possibility of relocating out there, and I sent to Neil a query, and I received an automatic email back stating that Neil had recently left. So I therefore contacted Daniel, who passed this on to Greville Ward, who's the head of High Net Wealth and International. And Grev came back saying that although what Neil was doing was of interest, it was only being used by a small number and not a broad section of Fundsmith investors. So I sent Neil a separate message on LinkedIn saying how disappointed I was for him, but also for my own selfish reasons, for what I gleaned from his expertise, and I wished him all the best for the future. So a few thoughts. You use it or you lose it, and perhaps too many investors couldn't be bothered to show their interest in this original offering, and this was only guidance, but I thought it was a great and a free way to equip and educate yourself ahead of speaking to somebody on a paid advice basis. And he could, give his views on various issues and of importance to private investors. And I think it would have continued to be very helpful to me. And Neil filled me with confidence and command of his subject. And I've had several provisional conversations with advisors about the tax implications of moving overseas. And there's been a number of keywords that have not inspired me. There's been words like potentially, normally, usually, should be, could be, and all being well. I want to know the concrete tax implication, and I don't want to commit to something only for it to come back and bite me in the backside. And in addition, in these conversations, they quickly turn to these advisors wanting to sell me a particular investment product now. So, also given that Fundsmith's assets under management are 22.7 billion, and fees are approximately 1%. So that's 227 million in fees. So does saving Neil's packaging in investing terms again turn the dial? It's a bit like going back to Manchester United. It's a bit like Jim Ratcliffe, what he's doing there and closing the staff canteen. Does it really make a difference? So I thought it brought an added service. It made me feel a greater involvement with Fundsmith and a distinct service offering. So anyway, Elaine and I were delighted to hear that Neil has just started with Blevins Franks. I'll say that again, Blevins Franks, as a financial advisor, and he will be specialising on cross-border taxation, which looks like it will be an area in demand, especially with the much publicised flight of high net worth individuals. So good luck, Neil.
That's great. Okay. Well, I think that pretty much wraps up the topics that we had listed to talk about today. Mark, thank you very much indeed for your review of the 2025 Fundsmith ASM. And we'll look forward to the 2026 one. If you want to make sure that you don't miss that one, please hit the like and subscribe buttons. Well, that's all for this episode. We hope that you enjoyed it. Please remember the content is for information only and it is not financial advice. If you have a question for Mark for our Question in a Bottle podcast, just complete the form on our website, thedesertislandinvestor.co.uk. Thanks again for listening. See you next time.